Good morning.
Good morning.
How is the going?
Good morning, Malim. Good.
Just confirming that you are hearing me.
Yes, I can hear you very clearly.
Is Jane Namu in? Jane. Jane Namu is not in. Can see she joined my meeting at 10 p.m. at night. Well, welcome on board. Our topic today is on farm accounts. And as we know, in most cases, especially here in Kenya, farmers, especially those who are doing subsistence, they do not care about maintaining any books of accounts, which is really serious because we say 68% of our GDP is driven by agriculture, which means that agriculture is a very vital activity that is worth maintaining books of. So you find that institutions that are doing agroeconomic activities are the ones that normally maintains books of account. Mute yourself when you join. It won't be useful if you are on and we are on. So mute yourself once you join. So I'm saying that the small scale farmers, they don't normally keep their books of accounts. Only those who are doing the agroeconomic activities, big farms like Kakuzi, Sasini, you have Shabana, the flower farms in Naivasha and other areas, etc. But we have an international accounting standard that stipulates how agricultural establishments are supposed to account for the books of accounts. So the International Accounting Standards 41 establishes the accounting treatment for, we call them biological assets. That is during the year growth, production, procreation, degeneration, etc. But this is up to at the point of harvest. So the accounting standards, it stands or it establishes for the biological assets until the time of harvest. Which means now, if, for example, let's say someone is, let's say in the business of, I'll give an example of, let's say you are growing grapes, and we know that grapes are used in, they are an input in the processing of wine. We are going to maintain the farm of the accounts for the farming of grapes until the day of harvesting. Once they become an input of the winery, it now converts into cost accounting, or what we used to call process accounting. You recall that? So we are counting until the day of harvest. So after harvest, for example, if you are rearing sheep and the purpose is to harvest the wool, once you shear them and the wool goes now to the yarn factory or the cotton factory, that is the end of your business. So our objectives here will be to get the true cost of each farming activity, because now this will be very helpful in controlling the cost. The reason why we maintain books of account, one of them is to try and control the cost. Being a business, we want to ensure that we are reducing on our cost of production to maximize on the profit that we are getting. So the objective number 2 is to ascertain that profit. Each agricultural activity to ascertain its profit, to ensure that we are able to control the establishment or the particular agricultural activity. Thirdly, proper maintenance of accounting records, of course, will help you to have, it becomes very easy even when you are borrowing, because the financier or the banks will want to know whether the person that you are dealing with is creditworthy. No bank will be willing to lend to you to go and do a business that they know that you will be losing. And we know agricultural activities are affected by the act of God, things like drought, yeah, famine. At times it rains. Yes, we need that water, but it rains more, so we are affected by floods. So you can imagine how ironical it is. You are adding, let's say, fertilizer to increase the yields, and then the fertilizer burns all the crops. So instead of yielding, you get the loss. So it's a very serious balance. So the farmer really want to understand whether there will be return on the capital employed, and the only way to ascertain this is by maintaining books of accounts. So that's why we are preparing the farm accounts. And they are specialized even in the manner of approach, because you should be familiar now with some of the peculiar features of the farm accounting or the farmers. For example, someone is doing the farming, but some of the crops that they are farming, let's say you are in the sukuma wiki farming, but you normally eat from that farm and you don't account for that. In business accounting, you are supposed to deduct that as a drawing because you are eating from your business. So you are supposed to see you debiting the drawings account and crediting the trading and loss account or the income and the expenditure account. You are supposed to be seeing that transaction happening. Secondly, you will find that it will be, or it is possible that the farmer is maintaining only a single account, which is not a problem as long as it is traceable. By single account, I mean your personal account is the same account that you are using to trade the sukuma wikis that you are growing. So being so, the private transactions are supposed to be segregated from the business transactions. If you recall in the financial accounting one, we have the entity concept where the business and the owner are supposed to be treated as separate entities. They are separate and distinct. But a farmer may open a bank account where they are doing their individualized transactions, and at the same time, they are doing the farming related activities, transactions in that account. So I've said what is important is to trace, is to be able to know that whatever the transaction I've done today is separately and distinct meant for the farm activity that I'm doing. This way you'll be able to trace whether you are making a profit or a loss in your farming activity without, of course, distorting or the distortion of the other transactions that you are doing in the account. So what is important in that account is the narrative. When you are documenting, for example, you can say sales of sukuma wiki. So you'll be knowing that the amount that you've deposited today is from the sales of sukuma wiki. So you can easily trace that. Also, you know that farming activities are subject to natural calamities. And I would say this is something that you cannot control. But being an activity that was recognized even by the International Financial Reporting Standards from 2000, the act was, not the act, the standard was developed in 2000 and it came into operation. It was operationalized from 2003. So 17 years down the line, we've had a lot of growth. Right now, even the insurance companies, they have what they call a crop insurance. They have even animal insurance. For example, you're in dairy farm. So your cow is an asset, that is supposed to be giving you the milk. So insurance will come and give you a cow cover to ensure that your cow is safe. Shall you lose the cow, they can easily compensate you. Of course, they have the mechanism of doing the valuation to know the value of the cow as at the point of offering the insurance. Some financial institutions like Equity Bank, they have cow loans. So they can give you a cow in form of a loan. You just go and apply, I need a dairy cow. They will tell you in our portfolio of cow assets, we have cows that are going for 120,000 and some are very expensive, especially the exotic ones. A cow can even cost 250,000. If that cow is able to give you 25 liters per day, then you don't joke, that's a business. Assume you are trading 1 liter of milk at 80 shillings, multiply by 25 per day, that's a lot of money. So Equity Bank will tell you in our portfolio of cows, we have a cow that is trading at 250,000. We have another cow at 150, at 100. So you choose whichever the cow that you want. Then they'll tell you, this is the risk. You see, we are giving you, we are extending this cow to you as a loan. So you are supposed to cover the cow. So at that point, you are going to take the cow insurance. They want to know that your cow is safe. Shall it happen that you lose the cow, because anything can happen. It can even contract Ridapest, East Coast fever, and you lose the cow. They'll know that the insurance will come and compensate them. So valuation becomes very important at the entry point. And that is our next point. Valuation of farm inventory is a very difficult task. It is very difficult, for example, to know the value of the standing crops. Let's say you are in the harsh avocado farming. How will you know you are opening inventory? Let's say you have the avocado account. Unless you go counting fruits one by one in those avocado trees, because those are the ones that you are going to sell, it really becomes a big issue, but you'll see how to approach it. Yeah. Then the output of the farming activity may become the input of another activity. I've given that example when I was talking of the grapes and the winery, or the wool and the cotton ginnery. So you are supposed to know that our mandate in farm accounting is from the point of starting to rear this cotton plant until the day we harvest the cotton. If they are 50 kgs and you are selling to the ginnery at 300 per kg, our output will be our sales, and that is all. I said when you join, mute yourself. I'll be forced to embarrass those people who are interrupting my class. Someone is in the traffic. Vivian. Vivian, how are you?
I'm fine.
Once you join this class, it's mandatory. You are supposed to mute yourself.
Sorry?
Mute yourself.
Okay.
Yeah, this is a class. It's like joining a class and you're making noise. You're interrupting the other learners. So once you join, kindly mute yourself. So I was talking of the end product or the output of farming being an input of the other process accounts. But you said our mandate will go to the sales of the wool. Once we sell the wool to the ginnery, we close our books because our purpose was growing that wool for sale to the ginnery. So the farm accounts may be maintained on what we call the double entry system. But subsidiary books here are very important than even the double entry in itself. Because what we really need to know is to be able to analyze the costs or the expenses that we are incurring versus our sales. So subsidiary books like ledgers, they'll be maintained for recording the transaction. Like if you go to Kakuzi, once they harvest the pineapple, they should be able to tell in the daily, let's say daily sales book. They should be able to say that today we harvested, let's say 10,000 pineapples that we gave to what do we call it? What do we call it? The pulping company. So they are producing their output in the farm. So the farm account will be until the point of harvesting the pineapples. So once they go to the production wine, now to the production line, now the production of the juice, they won't be concerned in the activities that are going there. So I've said that double entry system could be used, but our daily sales book or the daily, what we normally call the analytical cash book that tracks now the cost and the expenses becomes very important subsidiary ledger, because this is what will help us track the cost or the information that we need to prepare our final accounts. So you have different accounts. For example, if you are trading or if you are farming crops, now to obtain the cost and the profit of each product, you need to maintain the detailed accounts for the particular crops that you are maintaining. Let's say you are doing partially wheat farming and then you are doing maize farming. You expect to have two accounts. One of the accounts will be wheat account, the other one will be maize account. So each crop account should be debited with the opening stock. And then from there, we need to track the expenses that are incurred on it. And then of course, on the credit card side, what we expect is the sales proceeds and the closing stock. You could harvest, sell some of the crops, but some are retained in the store, awaiting, let's say, favorable prices, or you want to sell them at a later date. So on the credit side, you expect to see the sales or the closing stock. On the debit side, we expect to see the opening stock and the expenses. So it's as simple as that. So the balance on the crop account or this wheat account will be the profit or loss earned on that crop. Yeah. If, for example, let's say you are doing the maize, it will be a separate account. If you are doing vegetables, to ascertain the profit of whether the vegetables or the sukuma wiki gave you profit, we expect to see the vegetable account. That is crop account. When you come to the livestock, when you are rearing livestock, accounts should be maintained for each type of livestock. Let's say you are doing pig, you are doing dairy cows, you could be doing chicken. Nowadays, people are doing rabbits. So if you are in rabbitry, and let's say you are doing it to harvest the urine, I'm meant to understand that the urine is a vital product. The rabbit urine, a liter is going for 350 shillings. So someone may rear 100 rabbits, but the end product of that rabbit is not selling the meat. They want to be transacting the urine, which is used to manufacture some insecticide. So we expect that in the rabbit account, we are going to see the sale of urine. Of course, at the end of the day, when you'll be closing your you will end up selling now the rabbit. So it's good to cost each type of the livestock by debiting it. So you are going to have the cost of the rabbit as our opening stock in the livestock account. Then the sales proceed. If it is a dairy cow, we expect that you are selling milk or the other dairy products like ghee, butter. So that is what you are supposed to credit, right? So the resulting balance in the livestock account will be your profit or loss for that particular activity. You'll find in small farms, if the farming activity is small, different accounts for each type of crop and livestock may be avoided, so that the issue of apportioning now the cost do not arise. Imagine a situation where someone is farming but partly the sukuma wiki that they are farming, they give it to the rabbits. Are you getting the rationale? We said if you eat your sukuma wiki, you are supposed to debit the drawing accounts and credit your trading account, trading profit and loss account. Are we there? So if, for example, let's say you are going now to use the sukuma wiki to feed your rabbit, you can see the sales. You have to account for the cost of the sukuma wiki that you fed to the rabbit. So you expect that in your vegetables account or the sukuma wiki account, you've credited sales. Let's say sukuma wiki worth 50 shillings that was fed to the rabbit. So if you go to the rabbit, the sukuma wiki will be input. You are going to debit the rabbit's account, but you are going to credit the vegetable account. So that is for the small farms, but I've advocated for individualized account. For purposes of tracing the cost or the expenditure items, it's good to have each particular crop having its own account. All the costs that are incurred on it, be it cost of fertilizer, the labor that is incurred, etc., is supposed to be there. Another characteristic of subsistence farming is farmers do the labor, but they don't account for that labor. It doesn't make economic sense if you are going to spend a whole day in the farm and you don't account for your labor. Now, assume you didn't go to that farm. You would have hired someone else to do the work and pay them. So it is a cost. So notional labor is supposed to be put there because it is a cost that was incurred. But again, as I indicated in small or the subsistence farming, you don't normally account for these accounts. So I've said a single farm account is important for each particular activity, whether crop or the livestock. But where you are doing small farming, a single farm account may be drawn for all the activities. What you are supposed to do is you separate the accounts for various sets of activities. For example, you can have a crop account that accounts for all the small crops that you are farming in. You could have another set of book that is accounting for the dairy products. For example, you are doing milk, then you are further processing your milk, butter, ghee, etc. And then let's say you are doing poultry, you have broilers and you have layers. You need to split to know which one is profitable, which one is not. You just have a poultry account. So we are recommending that a single farm account should be drawn for an individualized activity that you are doing. So the other elephant in the room will be ascertaining of the opening stock. Now, what will be your opening stock? And how are you going to value it? Because we know in the International Accounting Standards too, we are required that assets that are considered as inventory, they should be recorded at the lower of cost or net realizable value. It's a requirement. It's an international accounting standard, so it has to be adopted. So the cost not only includes the purchase price. We know how we convert this cost in the basic accounting. We normally say our cost of sales is opening stock. We add net purchases. We add carriage inwards. We less return outwards, isn't it? And we less the closing stock. So how do we account for the stock in farm accounting? So a farmer is supposed to make an inventory and valuation of his farm assets. For example, seeds, that will be inventory. Now growing the crop, the fertilizer, the labor, etc., those will be running overheads. Are we together? If it is for the livestock, once you acquire that dairy cow, that will be your opening inventory. So at the beginning of each year, we expect the farmer to take the year stock and record them. So if you are preparing your books of account at the end of the year, it doesn't mean that if I buy a cow on 1st January, I'm going to dispose or sell the cow or slaughter the cow on 31st December. That cow will be my opening inventory next year. So I'll continue operating with this cow. Let's say its shelf life is 10 years. Then from there, the yield will have gone down and I'll dispose the cow. So as at the end of the year, I should be able to evaluate what will be the value of my cow coming January. And you say the basis is the cost or the market value, whichever is lower. Just the way we do the inventory in IAS 2. We value them at the market value or the cost, whichever is lower. And we normally do this because of prudence concept. We don't want to overstate or understate the value of stock. So in the case of livestock, where the farmer is not able to make an estimate of the actual cost of the, let's say, homebred cow, and you don't have the cost of the prevailing market value, in UK, they are valued at 75% of the market value. Most of these accounting standards, they were borrowed from the UK statutes, right? So where you don't have the market value of the cow, the actual cost of the homebred cow, you are going to value it at 75% of the market value. Are we there? Similarly, if the crops cannot be ascertained, we value them at 85% of the market value. So this is the standard. For the livestock, 75% of the market value.